Hi, everyone. Welcome to the virtual seminar on climate economics. My name is Fran Moore. I'm an associate professor at the University of California, Davis. Today, we're very excited to welcome Pari Sastry, who assistant professor of finance at Columbia Business School, previously serving from 2022 to 2023 as a climate finance postdoctoral fellow at the Department of Treasury. So today, Pari is going to be talking on the limits of insurance demand and the growing protection gap. And that, it's a new paper. We're very excited to kind of have it here today. We'll have a 50-minute presentation followed by a 25-minute Q&A. And I'll remind people that the seminar is being recorded for posting online, but we will stop the recording for the Q&A session. And thank you. And Pari, the floor is yours.
Thank you so much, Fran. I'm very excited to be here. This is joint work with Tess Charlman, Ishita Sain, and Anna Maria. Ishita and Anna are on the call with me. And the usual disclaimer applies. The views in the paper do not represent the views of the Federal Reserve System. So in terms of motivations, we've seen a dramatic increase in climate-related property damage over the last few decades. And at the same time, we've seen this very dramatic increase in homeowners insurance premiums. And this would make sense as risks rise, premiums would need to rise in accordance with risk. But we've seen a lot of public discussion, particularly among policymakers, that these dramatically rising premiums are making insurance kind of unaffordable for the average American household. And of course, we have this very rich literature in economics about what determines households' willingness to pay for insurance and what this means for the market. And in some of the sort of standard models of insurance, kind of going back to Arrow 1963 or Mawson 1968, rising premiums actually don't really pose any challenges because as risks rise, your willingness to pay for insurance will also rise. Because you're a risk-averse household, you have rising risks, so your willingness to pay will go up. But a lot of these models either implicitly or explicitly assume that households have frictionless access to credit markets and that households can always use debt to finance insurance premiums, borrowing against sort of future income or future wealth to do so. And so these models make a very strong and stark prediction, which is that at actuarially fair prices, households will be fully insured. And so even though risks rises and premiums rise in accordance, there's sort of going to be no change in the size of the market, and households will remain fully insured. However, there's sort of an alternate class of models of financial constraints, where households cannot frictionlessly increase debt to finance insurance payments. And in these models, because of the fact that households are constrained and they can't access debt, what happens is when these financial constraints start to bind, in fact, a household's willingness to pay for insurance may decline as risks go up, because rising premiums tied to rising risk will actually exacerbate financial constraints. So in this class of models, households may actually remain underinsured even when insurance prices are actuarially fair. And an implication of these models is that rising premiums that exacerbate financial constraints can in fact lead to a shrinking of the market. And so there are these two broad classes of theories with differing implications for household willingness to pay and household demand elasticities. But despite the sort of rich theory and this rich tradition, we haven't had much empirical evidence about these two classes of theories in the context of homeowners insurance in particular. And the primary reason for this, of course, has not been lack of interest, it's been lack of data. It's been very hard to get granular information on homeowners insurance premiums and coverage in the United States. And so while there's been a lot of public speculation about homeowners insurance markets, particularly in the last 5 years, there's really been an absence of academic work on these topics that have really been able to address the details of the demand side of insurance. So what we're going to do is we're going to bring to bear a very novel nationwide micro data set. So this is a new data set from ICE McDash, which has very detailed individual level information on homeowners insurance contracts as well as mortgage contracts. And this data spans 2013 to 2023 and covers the United States. So it's an extraordinary micro data set that has been newly released. And we're going to show some descriptive facts with this data, but we're also going to try to take a very deep dive into understanding homeowners insurance willingness to pay, as well as the role that debt markets play in supporting insurance. So we're going to find that the average American is in fact underinsured. So the average American only has 70% of their replacement cost covered by insurance. So what this means is that if there's a total loss event where the entire house is wiped out, the insurance payment will only cover 70% of the cost of rebuilding. So this means that households are not fully insured. And we're going to argue that a lot of the underinsurance that we observe is strongly correlated with measures of financial constraints. And we're going to take a deep dive in trying to understand the role that financial constraints might be playing in explaining household underinsurance. So our paper kind of consists of two main parts. There's going to be a theoretical framework. We don't think of the framework as being new. It's really just a single model that nests the insights of the standard model of Arrow and Mawson, as well as the sort of newer models of Rampini, Vishwanathan, and Erickson and Snyder. So it's going to be putting together kind of two broad classes of models into a single framework. And we're going to use it to derive predictions of how both insurance coverage as well as debt should evolve with premium changes. And we're going to identify that there are going to be three particular parameters of interest that drive a lot of what happens in the model. These three parameters are going to be the elasticity of demand for insurance coverage with respect to insurance prices. So that's sort of natural, that comes from the literature. But we're also going to identify two additional parameters of interest. The first is going to be the cross-price elasticity of debt with respect to insurance price. So that is, how does mortgage debt adjust as insurance premiums change? And we're also going to identify how insurance coverage changes with respect to changes in the interest rate. So that's a cross-price elasticity of coverage with respect to the cost of credit. So our model is going to show that these are the three kind of parameters of interest to identify. And then we're going to focus the next half of the paper to actually identifying and estimating those parameters. And to do this, we're going to use a novel instrument to try to actually estimate demand elasticities to address some of the classic simultaneity problems. And that's going to be based on exploiting regulatory frictions that make it hard for insurers to adjust premiums. And I'll go into detail about what that means when I get to the IV. So based on this, we're going to have basically three broad set of results. The first is going to be that at actuarially fair prices, households are underinsured and have elastic demand for coverage. So this is not the world of Arrow and Mawson. This is sort of a different set of results. The second is we're going to identify this interesting heterogeneity where for financially unconstrained households, these are households that can frictionlessly access debt markets. We see that rising premiums actually lead to an increase in debt, but that these households don't actually adjust coverage. So these unconstrained households are relatively inelastic because we argue, because they can adjust debt. So their debt adjustment can support their insurance coverage. So these guys kind of act like the Arrow and Mawson borrowers that we would expect with inelastic demand as well as frictionless access to credit markets. However, for financially constrained households, these are households that are very close to binding debt limits. They can't adjust debt because lenders don't allow them to. And so what we see is that they're very elastic in their demand for coverage, and that these households are really the ones that are reducing coverage the most in response to changes in prices. And so whether debt adjusts or coverage adjusts in response to exogenous shocks to premiums is going to depend heavily on household financial constraints and access to debt markets. Oops. So to kind of put our paper in the context of the literature, there's a rapidly growing literature now on homeowners insurance and real estate markets writ large. A lot of this is related to the availability of very new data on insurance, and people are studying a variety of issues, including house prices and other kind of related questions in real estate markets. This is just a subset of the new papers. There's many more than three. But our real contribution to this broad literature is going to be taking a deep dive into insurance demand. So we're going to connect more to the sort of traditional insurance literature, thinking about the drivers of insurance demand. So the theory, of course, dates back to Arrow 1963 and Mossett 1968, which are the sort of standard models of demand. And of course, there are these newer models that I've already mentioned, Rampini and Vishwanathan, Erickson and Snyder. We're going to draw heavily from this work by Liran Einav and Amy Finkelstein on how to think about the econometrics of estimating demand elasticities. And of course, there's a variety of estimates in the literature of demand elasticities across a range of markets. We just have a subset here, but we have estimates from health insurance, life insurance, flood insurance, and crop insurance, but we don't really have estimates from homeowners insurance. So our contribution is going to be threefold. We're going to be the first to identify an own price demand elasticity for homeowners insurance. And we're also going to be the first to identify these cross price elasticities between homeowners insurance and mortgage debt. So that's going to be kind of an identification related contribution. The second is going to be, we're really going to hone in on the role of financial constraints coming from the mortgage market and how those constraints have a strong influence on household demand for insurance and willingness to pay. And I think we're going to be the first to show that households are using mortgage debt to finance insurance coverage. So this is going to be another way in which insurance and mortgage markets have this very inextricable link, which is kind of a set of questions that me and my co-authors are interested in trying to understand. How insurance and mortgage markets together are jointly exposed to climate risk and the role that one plays in supporting the other and vice versa. So that's going to be kind of our contributions. And we're going to argue that our results have a set of broader implications that are going to be interesting for anyone that's interested in climate. So really, another way to think about our results is that financial constraints are reducing household willingness to pay even below expected losses. That's what it means for them to have elastic demand even at actuarially fair prices. But insurance companies have to charge at least the expected loss in order for them to remain solvent. And so what this does is this may actually destroy the gains from trade that come in insurance markets. And we may see this having an impact on sort of the future of the market. And so that's sort of a first key takeaway. The second key takeaway is that if price increases continue at historical rates, we estimate that between 17 and 31% of households will go from being unconstrained to constrained because they're going to adjust debt so much that they actually hit binding mortgage market down payment constraints. They're going to hit binding loan to value constraints. And as a result, they will end up becoming more elastic than they are now, and they're going to have to reduce coverage. So there's this first order effect where people who are already constrained are elastic, but there's going to be the second order effect where people become elastic because they hit binding LTV constraints in the mortgage market. And so taken together, putting everything together, what this means is that insurance markets may actually shrink in size even as climate risks go up, which we don't want to make welfare statements, but for those of us who are thinking about climate change and how households can hedge those shocks, insurance is an important market for that. So this kind of raises the question of how useful financial markets will be in the future as climate-related risks go up. So I'll start with some institutional details. Much of this may be familiar to anyone that has bought a house. I live in New York, so unfortunately that's not me. So I'm going to go over it anyway. So homeowners insurance is really the key contract ubiquitously used by households to hedge climate losses. Of course, there are other related insurance contracts too, but really 85% of American households have homeowners insurance. So take-up rates are extremely high in homeowners insurance. And the key risks that are covered here are things like wildfires, hurricane-related wind damage, and a lot of key climate-related risks. And a lot of, so nearly 93% of losses in homeowners insurance are climate-related. This is an estimate by the reinsurer Swiss Re. So there's sort of two key features of the homeowners insurance contract. The first, it's an annual contract. So you have to kind of renew it every year. And there are two key aspects to the homeowners insurance contract. The first is a coverage limit. So when you get homeowners insurance, you actually have to choose how much coverage you want. And so households are entitled to receive claim payouts up to this limit if a loss event materializes. So if I have $2 million in losses, but I only get $1 million of coverage, I'm going to be underinsured for that remaining $1 million. That's above my coverage limit. Once I choose a coverage limit, then I pay a premium, which is also a function of the coverage choice. So these premiums are paid monthly, and they're going to be set as a function of the risk exposure of the house, the coverage choice of the household, and other insurer costs. So that's going to be kind of the two key features of the contract. There is, of course, also deductibles. That's another key aspect of homeowners insurance. But in the data, we find very little variation in deductible choice. So we don't really focus on that aspect here. And in terms of timing, this is also going to be very important for our study. The key point for us is that homeowners insurance is purchased only after the housing decision is made, but before the mortgage closes. So usually the way things work is when you buy a house, you put some kind of a deposit down to secure the house so that no one else can put in an offer. And then you are sort of forced by your lender to find homeowners insurance and escrow up to 1 year of homeowners insurance payments, as well as mortgage related payments and property taxes. So you get the homeowners insurance information only after you've put down the offer, but before the mortgage closes. So once you find out the details of the premiums, you actually still have time to adjust the mortgage contract. And so the timing here makes sort of mortgage and homeowners insurance premiums actually like a joint decision. The other piece, which I've already mentioned, is homeowners insurance is very salient, not just because you're required to get it, but because you actually have to escrow homeowners insurance payments at origination. So lenders will require you to put aside 6 months to 1 year of insurance payments in your escrow account. So you're very, very aware of the premium that you have to pay because you have to pay 6 months of it upfront. So it's a very salient feature of the contract. So that's kind of the relevant institutional details that is going to motivate our study.
I think we have a clarifying question
Oh, yes, sure,
from
go ahead.
Richard Tall. Hang on, I should be able to let him unmute.
Go ahead,
Oh,
Richard.
sorry. No, I have to.
Oh,
Okay, there we are. Pari, I've never bought a home in the US. In Europe, it is common that the mortgage lender is also an insurer and they just offer this as a package. Is the same true in the US?
that is not true in the US, and that's very interesting. Lenders do not offer insurance typically. They usually require that you get homeowners insurance from a third-party insurance company.
Hey, thanks.
Mhm. And that is very interesting. I didn't know that about Europe, so future research. But yes, so very good. So now I'll talk a little bit about the data. So as I mentioned, the key data set that is really that we really kind of utilize is this new nationwide loan level database, which we're able to merge with other databases to obtain very rich information at the individual level on the homeowner's insurance contract, the mortgage contract, borrower characteristics like the borrower's income and credit score, as well as property characteristics, including the replacement costs of the property and the climate risk exposure of the property. So to do this, we're going to bring to bear these 6 different data sets. The ones that are not in red are very well known in the mortgages literature, but I'll still go through them anyway. The first is this McDash mortgage module. This is going to be very detailed information about the mortgage contract at origination, as well as the performance of the mortgage over time. So for this, we're going to get information on the loan amount, the loan to value ratio, the debt to income ratio, the interest rate on the mortgage, the credit score of the borrower, and whether the mortgage defaults or becomes delinquent. We're going to merge this baseline McDash data with this new McDash data on insurance. That's the McDash insurance module, which is going to give us additional information at the individual level on that particular borrower's insurance coverage and premiums that they've paid. We're going to bring this in with credit bureau data from Equifax to get the borrower's income. And then we're going to also bring in property characteristics from CoreLogic deeds, which is going to give us geographic information, the age of the structure, the size of the property, replacement costs. And then we're also going to bring in a property level measure of climate risk from CoreLogic, which is going to be an expected annual loss measure. It's like a dollar value of expected losses. And so that's going to be our measure of climate risk. And we're also going to bring in data from the RS Means company, which surveys construction home builders, and we're going to get estimates of local construction costs from RS Means. So our data set is going to combine all of this at the individual level. So there are going to be two key ratios that I refer to throughout the presentation. The first is the coverage ratio. This is going to be the coverage that we get directly from the McDash data, divided by the replacement cost, which is the amount it would cost to reconstruct the exact same home if it was completely destroyed in a climate event. So the coverage ratio here is going to reflect how much of your replacement cost do you actually have insured. The second ratio is going to be the insurance price. This is going to be the ratio of your monthly premium divided by $100,000 of coverage. Premiums are mechanically related to coverage because premiums go up as you take on more coverage. So usually in the insurance literature, the price variable is really the correct notion of price, or like of prices. Ben, go ahead.
I had a quick question about the replacement cost. So I should note I'm buying a house right now. This is very relevant for me. I have to decide on an insurer today, which feels like choosing an ice cream flavor or something to me in this process. So in this process, there's these different replacement cost estimates that insurers use. They're a black box. They're like a regression or something where they're putting information in. And they'll give you wildly different quotes. On my house that I'm giving quotes right now on, they range by 10 or 15%. So this seems like an important factor here, where like if some insurers are using a lower estimate versus a higher estimate, it could affect some of the top line numbers we're talking about.
That's right. That's right. So replacement costs are estimated, as you said. Our estimate here is going to be pretty simple. We're using the square footage of the house, the age of the house, and the location. We've looked online, and a lot of insurance companies, when they talk about how they estimate this, those are the top 3 characteristics that they use. So even though there is a variation, we sort of think that we're capturing the most salient features of a replacement cost here. Our understanding, based on actually Tony Cookson's paper, is if anything, our estimates are an underestimate. So their estimates of underinsurance, their estimates of replacement costs are actually much higher than ours. And so we feel fairly comfortable that we're not overstating the underinsurance problem. If anything, we're understating it. And for them, they actually get data on, I think they are able to survey construction builders, and they find that RS Means is an underestimate.
So I think one of the other challenges here is that like some agents won't let you, there's constraints, like some agents won't let you buy below the replacement cost estimate because there's errors and omissions lawsuits that can come from that if you have a large loss. And then like the lender has some vested interest here too. So I don't know. Yeah.
How does that play? Yeah. So on the lender side, and I'll talk a little bit more about this, we find that lender loan amounts are more or less covered. So the underinsurance is really eating into the household's equity. And so I'll talk a little bit about that towards the end. So lenders, they do play a role. They're not going to let you underinsure so that they're exposed. But we think this is sort of more on the household equity side, more of an issue there. And on the insurance companies, not letting you underinsure, I think that is right. But I don't think that that's ubiquitous. So I think my understanding is, yeah, that like some may let you underinsure and some may not. But this is sort of part of the household shopping problem. Our argument is some households are financially constrained. They can only borrow so much to help finance insurance. And so whether or not they can adjust coverage is going to be part of the shopping problem. So totally agreed. Yeah. Patrick?
Yeah, I have a related question here. So in terms of measuring the risks that the households are bearing, as you pointed out, it's different from the risk that the lender is bearing. So when you look back at what happened in LA with the wildfires, there was very high income shocks for the homeowners whose house burned down in terms of they had to relocate, they had to find rental accommodation while their house is going to be rebuilt.
Yes.
And in a context where you have a fixed supply of housing and a sudden shock in increased, substantial
Yes.
increase in demand for housing.
Yes.
Prices were crazy, right? Some of the rental
Absolutely.
prices that we saw in the papers were just insane.
Yes, yes.
So my understanding is you're not taking that risk into account at all, right?
That's right. So this is another way in which our headline estimates may be an underestimate, and we're interested in this. Construction prices, like the cost of construction booms after natural disasters because demand demand for construction increases, right? Because people are rebuilding and maybe repairing their houses. And so there are some insurance contracts that if it's called guaranteed replacement cost coverage. So if you fully insure, so you can't be like insuring at 60% replacement cost and then get a guaranteed replacement cost contract. You have to get a full replacement cost contract, but you can get a rider in addition to that that will give you some leeway if construction costs go up and insurance rebuilding costs exceed the estimated replacement cost at the beginning of the contract. So there are some contracts out there to help address this kind of like aggregate shock local aggregate shock, like a California aggregate shock after the fires. But our findings are that the majority of people don't have this. And so this is yet another way in which they're underinsured. Yeah, exactly. So if anything, I mean, I know this is a standard thing to say, but if anything, our take is that we're underestimating the size of the problem because of all of these other shocks that can also happen at the same time. But our results are already pretty stark. Yeah, yeah, great. So now I'll show you some of the descriptive facts from the data. So kind of building off the discussion we just had with Patrick, this is just a histogram of our estimated coverage ratios for the entire sample. And what we see is that there's only a tail of people who have full insurance or are overinsured. The vast majority of people are underinsured. And in fact, the average person has about 70% of their rebuilding costs covered. But we see that there's also a sizable percent that have less than 50% of their replacement costs covered. So this is what we would call severe underinsurance. So this is a very stark problem that seems to apply to the majority of American households, not just sort of a very small tail of very low income people. We're talking about the average American here. And the other thing that's interesting is we looked at this heterogeneity across states. And so you might expect that the places with the most climate risk, for example, like the Gulf states, like Texas, Louisiana, et cetera, would have sort of the highest demand for insurance because they have the most risks. But if you look just at the cross-state correlation, the correlation between coverage ratios and climate risk is negative 20% in the cross-section. So it's not the case that the states with the most climate risks are the ones that have the most coverage. In fact, the much bigger predictor of coverage ratios is state level income. The state level correlation between coverage ratios and income is 80%. So already we're starting to see that some of the standard intuitions that risk exposures may drive willingness to pay don't sort of appear in the aggregate data. And then we can obviously oh yeah, Ben? Mm-hmm.
Oh, just wanted to ask, is this the coverage limit only at origination, or is this like later on in the contract?
Great. So yes, I should have clarified. This is at origination, but we find in the paper this interesting fact that coverage ratios are pretty stable over the life of the loan. So we argue that underinsurance really seems to originate at the beginning, and it persists over time.
So like over time, the insurance limit is being adjusted to some degree by the insurance agent, I guess, for
yeah, for like
costs
inflation,
and things like that. Yeah. Okay.
Exactly. Mm-hmm. Great. So this is just, again, a broad cross-sectional correlation across states. Now we have the data to do this at a more micro level. So now we're going to show some similar patterns looking at bin scatter by income. So on the x-axis, we have household annual income. And on the y-axis, we have the share of households that are severely underinsured. This is the share of households with coverage ratios below 50%. So this is really, really underinsured. And as you go up in the y-axis, you're more underinsured. So there are kind of two interesting things that I wanted to point out. The first is that as you increase income, coverage ratios go up. So higher income people are less underinsured. So this already kind of is contrary to standard models where household risk aversion is declining in wealth, like CRRA preferences. Wealthier people have less risk aversion and have less need for insurance because they can self-insure. This is kind of an implication of the standard model with CRRA preferences. That is not what we see in the data. We see that wealthy people have more insurance. So that's the first pattern, that this is a downward sloping line. Wealthy people have more insurance, lower income people have less insurance, and it's pretty stark. The other thing that is interesting is if you look within income ventiles, so for example, let's say if you look at people earning like 80K per year, you get that lower risk people have less insurance than higher risk people. So higher risk people here are less underinsured. That makes sense. They have more risk. They have more demand for insurance. That sort of goes in the right way. But as you get to the lower income part of the bin scatter, we see that there's no difference between high climate risk and low climate risk insurance take up among the lower income people. So you see this interesting twisting where sort of the higher income people seem to obey some of the more standard Arrow 1963, Mawson 1968 intuitions about the role of risk and willingness to pay, where higher risk people have a higher willingness to pay, but like lower income people, that seems to go away. So we see this twisting that happens as you get to very low income households. And we also see that pattern hold if you split the sample, not by income, but by the credit score of the borrower. And so this is all kind of descriptive, of course, none of this is causal, but this is some of the motivating facts to have us start thinking really about financial constraints, where like in these models, it's not, declining risk, it's not really necessarily risk aversion because we see this pattern with income, but it's really like something to do with the affordability or the fact that lower income people cannot afford to pay insurance for some reason. Ben?
Sorry, I don't mean to dominate the questions here, but I think this is really fascinating, Pari. So like if you think about types of houses from low income to high income people, like the square footage and bedrooms and so on, I guess like captures some important variation, but there might be a lot of other variation related to the quality of materials, countertops, or whatever else, where you would, I guess, sort of think about that a type of variation here that goes along with that that people who have nicer countertops are going to buy more insurance and they're going to look like they're more insured relative to people who have less nice stuff. So how should we think about like those unobservables correlating with stuff like income for this analysis?
That's right. I mean, so again, it's true. We don't really observe all of those really refined characteristics of the property, like what you're saying. But I have some data actually in my job market paper, which suggests that like 90% of the variation comes from just those characteristics. The variation in insurer estimates of replacement costs come from just those characteristics I mentioned. And that I do by looking at the FEMA flood insurance program and their estimates of replacement costs and how that correlates with property characteristics. So I agree with you, there may be some measurement error of replacement cost, but it's only going to be maybe between like 5 to 10,000 based on what I found in my job market paper. Again, that's flooded, like, there are grounds to nitpick at that as well, like flood insurance program replacement cost estimates may be different from private insurers, like all of that is well taken. But given what we find in our default estimates later, which I'll kind of hint to, this seems like it is capturing a true level of underinsurance. So we do see that default is correlated with, or is, we're going to argue it's a causal relationship. Households that are lower income have a stronger correlation between coverage and default than higher income households. So that wouldn't necessarily be true if they were fully insured in the same way. So I think I would love, actually, I'm in talks with a data provider right now, actually Verisk, I've spoken about this with Anna and Ishita. They're kind of a provider of replacement cost estimates to the industry. So we can try to benchmark our own estimates with the industry. So to summarize, first, based on the flood insurance data, I think this is a pretty good proxy. Secondly, I'm not as worried about this going in the direction of being an underestimate based on what I said earlier. I think if anything, we're overstating coverage ratios based on Tony's paper. And the third is we have scope to improve measurement and we're thinking about that. And the last thing I'll say, in our regressions, we're going to sort of look at coverage with a control for replacement costs, as well as other really rich characteristics. So some of that will be soaked up. Like we're going to control for credit score and income and stuff. So to the extent that those capture some of the variation that we're talking about in building quality, that's not going to be an issue for our demand estimates. Yeah. Great. Okay, so this is just a descriptive facts. So we're going to try to actually go a step further by thinking about understanding what would be optimal. So we want to make a statement about sort of optimal coverage or optimal debt choices. So for this, we're going to do a very simple exercise. We're going to think about optimal insurance and debt choice in a standard consumption savings model. So this, like I said, it's going to nest the sort of classic theories with some of these new theories on financial constraints. And what's important for us is it's going to generate new predictions on how debt should adjust in response to insurance premiums. We looked for that in the literature. Those predictions weren't there. So this is really the kind of the reason that we bring this new model into the paper. So in a world where households are unconstrained, they can borrow frictionlessly in credit markets. We obtain the following predictions. Households that are unconstrained are going to be fully covered. So this is K is the share of coverage that you have. So you're going to have 100% coverage. You're also going to be completely inelastic. So your elasticity of coverage with respect to insurance prices is going to be 0. Again, this is at actuarially fair prices. So that's the assumption for this. And also at actuarially fair prices, you're going to have that households can adjust debt in response to premium shocks. So they're going to actually have this non-zero elasticity of credit where they're going to borrow more if insurance premiums change. So these are the predictions of the sort of standard model where households are unconstrained and things are frictionless, and insurance prices are actuarially fair. But if households are financially constrained, even under fair prices, we're going to find that, in fact, they're going to be underinsured. They're going to have less than full insurance, and they're going to have elastic demand for coverage. So they're going to be sensitive to insurance prices in their coverage choices. But what's going to be interesting is for these households, their debt choice is going to be insensitive. And the reason for this is obvious. They're at binding debt constraints, so they literally cannot adjust debt. So even though they might have liked to adjust debt if they were unconstrained, they can't because they're constrained. So debt is going to be insensitive to insurance prices, but coverage is going to be sensitive. And that's all at fair prices. If prices are above actuarially fair, there's going to be similar predictions that hold, but it's going to be about relative differences. So when prices are above fair, the unconstrained household is going to have more coverage than the constrained household, just not going to be 100%, but it's going to be, they have more coverage than constrained households. The unconstrained people are going to be less elastic in their demand. So constrained households are going to have a higher demand elasticity for insurance than unconstrained people because they have to adjust coverage. And lastly, on the debt side, constrained households are going to have lower debt sensitivities than unconstrained households. And this is because they can't adjust debt. It's going to come from that. So this is going to be differential predictions on how debt and coverage adjusts based on whether households are constrained and based on whether prices are actuarially fair. So that's kind of going to be the theoretical predictions. So now we're going to have to try to estimate these. So of course, estimating demand elasticities poses an econometric challenge. There's a classic simultaneity bias. And we also have this additional issue when we bring in debt, which is there's all sorts of other unobservables that correlate with debt choice that we need to address with an IV approach. The ideal experiment in our setting would be if we randomly assign insurance prices across households, and we saw how households endogenously adjust insurance and debt. And so that's going to be our motivation for the kind of variation we seek to get. We're trying to get variation in insurance prices that are exogenous to insurance demand, as well as credit conditions. So what we're going to do is we're going to exploit this feature of US regulation, which is explored in another paper by my co-authors Ishita and Anna in their forthcoming JF, where they look at regulatory constraints on pricing. And in particular, they identify 2 sets of states. There are high friction states where regulators actually prevent you from adjusting premiums in response to changing risks. or demand conditions or credit conditions or anything. It's just very, very hard to change prices in these high friction states because of regulatory frictions. Whereas there are low friction states where insurers have much more flexibility to adjust prices. And so we're going to exploit this fact in our IV. And what we're going to do is a sort of Hausman type approach where we're going to use prices in high friction states as an instrument for prices in low friction states. And I'll go over exclusion and relevance in a second, but to just set ideas, the regression we're going to run, our first state is going to be, we take prices in high friction states, and we're going to regress them on prices in low friction states, and we're going to have these rich controls, like I mentioned to Ben Collier earlier, we're going to have these zip code year fixed effects, property level controls, climate risk controls, replacement cost controls, as well as borrower controls for income and credit score. So we're going to control for all of that, and we're going to look at variation in prices from high friction states. And then in our second stage, we're going to have two main outcomes. We're going to have coverage as well as debt. So we're going to then regress coverage on our instrumented prices with those same controls. And the coefficient on price on the instrumented price is going to be what we call our elasticity of demand, our coverage elasticity of demand. This is how coverage adjusts to exogenous changes in prices. And then when we have debt on the left-hand side, our elasticity is going to be a cross-price elasticity of demand for mortgage debt with respect to insurance prices. So what's going to be important here is our instrument, all of this in the second stage is going to be estimated in low friction states. So what are the identifying assumptions? So the first is, of course, that prices in high friction states have to be relevant to prices in low friction states. And the idea for why this is the case is going to come from the intuition of their paper that I mentioned, Osa and Tenekejevia. And the idea here is that, it's explored in more depth there, but to give you the flavor, the idea here is that there are certain high friction states where insurers operate at a persistent loss. So here we have combined ratios which come from insurer statements, and a combined ratio of 1 means that insurers are paying out more in claims and expenses than they're earning in premiums. So this is the ratio of claims plus expenses divided by premiums. So here they are barely profitable. Whereas in low friction states, we see that combined ratios are significantly below 1. So we're seeing that in low friction states, insurers are profitable, but in high friction states, they aren't. And the idea of the paper of Ishita, Anamaria, and Simon is that insurers that are operating in multiple states cross-subsidize losses in high friction states by adjusting premiums in low friction states. So because of this cross-subsidy, the price you can charge in a high friction state is going to influence the price that you charge in a low friction state. So we're going to test this. We show that there is this strong first stage where we do see this relationship between prices in low and high friction states. And a lot of the reason for the cross-subsidy comes from this work by Koyin and Yogo, where multi-state insurers are still financially constrained, and they would like to adjust prices everywhere in response to losses, but they can only do so in low friction states. So the cross-subsidy is why the instrument is relevant. And the exclusion restriction is going to come from the regulatory constraints on pricing. So the identifying assumption we have to make is that prices in high friction states only influence demand in low friction states through the effect that they have on low friction state prices. Patrick?
Yeah, that's super interesting. But this raises the question of fair pricing.
Yes.
If there's cross-subsidization, to what extent can you still claim fair pricing in low friction states?
So I'll get to this in a second, but fair prices are not fair in low friction states. So in low friction states, prices are going to be above fair, for sure. But we're going to argue that prices in high friction states are at or below fair because of these persistent losses. So we're going to identify a demand elasticity for high friction states.
Yeah, I understand that, but when your theoretical predictions were all based on fair pricing, so I wonder how you would adjust that.
So they're both. We have predictions on fair as well as unfair prices. Yes. Yes. Adele?
Yeah, I'm thinking about your high climate risk versus low climate risk. And I wonder if crime might work similarly in that areas in higher crime, there might be the same dynamic in how homeowners choose their bundle of mortgage and insurance?
Yeah, I mean, I think the biggest driver of premium increases is really expansion of properties in high risk areas. So that's kind of why we're focusing on climate risk. But in principle, anything that makes premiums go up can exacerbate financial constraints. So certainly, this is not unique necessarily to the climate setting, but it's sort of there's some work by Sastry and like Ben Keyes and Phil Mulder in their recent paper showing like premium increases in homeowners insurance is sort of very closely tied to changes in disaster risk. So that's kind of why we focus on that setting here. But I agree with you, anything that kind of causes premiums to go up, like increases in crime, could exacerbate household financial constraints this way. Great. So we talked about the relevancy, and just to kind of recap, high friction states are where we think prices are below fair based on, or at or below fair based on the combined ratios that have been persistently at or above 1. And then low friction states are where prices are above actuarially fair. So now I'll talk about the exclusion restriction. The exclusion restriction here is that prices in high friction states are only influencing demand for credit and demand for insurance in low friction states through the cross subsidy, through the effect that they have on low friction state prices. So another version of this that's intuitive is that prices in high friction states are exogenous to insurance demand and credit conditions in low friction states. So obviously it's hard to test an exclusion restriction directly or an exogeneity assumption, but to help kind of provide some supportive evidence of this, we're going to show that prices in high friction states don't even reflect actuarial risks in high friction states. So the biggest driver of demand for insurance is going to be your risk exposure in the standard models. And what we see is that in low friction states, there's a very strong pass-through of insurance prices to climate risk. So here, climate risk is a dummy for whether the property is in the top 10% of expected losses in the core logic distribution. So these are very, very risky properties. And the question is, do those properties have higher prices than everyone else? And we do see that that's true in low friction states, but in high friction states, we see that that pass-through is completely undone. So the pass-through of climate risk to prices is almost zero in low friction states. I'm sorry, in high friction states. The pass-through of risk to prices is zero. We have a number of measures in the paper besides this one. But the idea here is that if insurers can't even adjust prices in response to extreme risk, it's very unlikely that regulators are going to allow them to adjust prices to reflect demand shocks in other states. And so that's sort of some intuitive evidence in favor of our exclusion restriction. The other piece that's important here is that most price changes in high friction states, if anything, are price increases. We don't actually see kind of any price reductions. So the reason I mentioned this is that insurers would have liked to raise prices in high friction states. That's clear from the evidence we saw on profitability, as well as what we're seeing here based on climate risk, but that's really a constraint and they can't, so they're adjusting in low friction states. So that's the idea of the exclusion restriction. The key here is that prices in high friction states cannot adjust to demand shocks in low friction states. So now I'll show you some of the results. The first is how coverage choices vary by actuarial fairness. So in the second column, we're going to look at high friction states, and we argue based on the profitability that in these states, prices are at or below actuarially fair. So in these states, the Arrow-Mawson model would predict that households are fully insured because prices are at or below fair. But in reality, what we see is that coverage ratios are about 68%. In addition, the Arrow-Mawson models of the unconstrained borrowers would predict that households are completely inelastic, but in fact, we find that household demand elasticities in these high friction states are minus 0.25. So clearly, we're not in the world of Arrow-Mawson here based on what we're seeing in demand elasticities and what we're seeing in coverage ratios. So the actuarial fairness of the contract may not be what's explaining coverage choices. To kind of complement that, we're now going to look at low friction states. In low friction states, coverage ratios are about 69%. So even when prices are significantly above fair, we're seeing very similar coverage ratios. Further, if you look at the demand elasticity, we're seeing that households are also elastic in their demand for insurance in low friction states when prices are above fair. So both of these results kind of taken together suggest that the generosity of the contract or the actuarial fairness of the contract doesn't seem to be the first order driver of coverage ratios, given that coverage ratios are very similar in low friction and high friction states. Another implication of this result from high friction states is that household willingness to pay is below the expected losses required for insurers to remain solvent. People are dropping insurance coverage even when prices are fair. So that suggests that some of the standard models of willingness to pay are not what's driving things here. And the fact that coverage elasticities are broadly similar in high and low friction states also speaks against some of the focus on the actuarial fairness of the contract. So this is the first sort of set of results that we argue kind of take us away from the world of Arrow Mawson and bring us into the world of Rampini and Vishwanathan, financial constraints. So
Pari,
now
I just want to flag that we're at 8:50, but you did have a lot of interruptions. So no, we'll definitely give you another 10 minutes. And I would say maybe let's hold the question for the Q&A period.
Okay, thanks, Fran. Okay, let me make some progress here. Okay, so the next thing is going to be about thinking about the role of financial constraints. So the first thing we're going to do is a very simple exercise. It's obviously very hard to measure financial constraints. So what we're first going to do is a simple sample split where we split the sample by high and low income borrowers defined at the median of income. And the way we're going to justify this is if you look at kind of debt constraints from the mortgage market. So these are debt to income limits or loan to value limits. We see that lower income borrowers are 2 times more likely to be at these binding DTI or LTV thresholds than higher income borrowers. So our first approach is going to be to just split the sample by low and high income borrowers and look at how coverage and debt adjusts differently for these two groups of people. So what we're going to find is, in fact, kind of consistent with our predictions, there's going to be this very interesting heterogeneity in who adjusts coverage and who adjusts debt. So if you look at high income borrowers, these are the borrowers that we argue are more likely to be financially unconstrained. We see that they're not so elastic in their demand for coverage. So the elasticity of demand for coverage is roughly minus 0.08. But what we see is that they're very elastic in their demand for debt. So they adjust debt significantly in response to changes in insurance prices. So the elasticity here, the elasticity of debt with respect to insurance prices is 1.078. So this suggests that they're able to kind of maintain insurance coverage because they're able to access debt markets. In contrast, if you look at lower income borrowers, we see that they're significantly elastic. So their elasticity is minus 0.192. So here they're significantly reducing coverage in response to changes in premiums, but they're not as able to adjust debt. So we see the lower income borrowers' elasticity of debt is 0.529. So it's less than half the debt elasticity of the higher income borrowers. So these heterogeneous patterns are consistent with our model where constrained people reduce coverage because they can't adjust debt as much, whereas higher income people are able to maintain coverage because they're able to adjust debt. And if you look at a kind of back of the envelope, we have two kind of quantifications. The first is that our results imply that for constrained households, if we have a persistent 2% increase in prices, they're going to actually drop coverage by $5,500. So this is kind of like how much the dollar adjustment in coverage that we're seeing. But the other piece is if you look at unconstrained borrowers, it seems like they're financing about 35% of the expected burden of the rising premiums using the mortgage market. So the mortgage market is playing this very significant role in helping to finance their expected premium burden over the life of the mortgage. So of course, you might be concerned high income and low income borrowers are different in many other dimensions. There could be different in their beliefs about climate risk and their risk preferences, their sophistication or risk tolerance. So this is sort of maybe some other stories that may explain the heterogeneity that we're seeing. So ideally, what we would have is an exogenous shock to financial constraints. So we're going to argue that we're going to try to proxy financial constraints by looking at changes in the interest rate. So the idea here is that when you have changes in the interest rate, it makes it harder to finance insurance premiums using debt. So households should have more elastic insurance demand when interest rates are higher. Of course, we're also going to have an exogeneity problem here. Interest rates are also correlated with many unobserved determinants of demand. And so we're also going to need a source of exogenous variation here. And so what we're going to do is we're going to use the same IV as earlier for insurance prices, but our exogenous shock to interest rate is going to exploit this unique feature of mortgage markets, where the government-sponsored enterprises, Fannie Mae and Freddie Mac, require what's called private mortgage insurance for households with loan-to-value ratios that exceed 80%. So the idea here is that if you're at 79% versus 81%, you have a discontinuously higher borrowing cost that increases by 50 to 80 basis points. So just by being on one side versus the other, you're going to have this huge difference in the cost of credit. And we're going to compare borrowers that are slightly above 80 versus slightly below 80 to see how their demand elasticities change. So the idea here is that households just above the LTV, the 80% LTV threshold, are going to be more elastic than borrowers just below. The identifying assumption is we're going to look within very narrow bands around 80%, and we're going to argue that other determinants of demand for insurance are going to be similar around within those narrow bands. So if you look at the results, if you look in the first column, this is looking within 10% of the LTV limit. We see that borrowers slightly above 80 are significantly more, are nearly 30 to 50% more price elastic than borrowers below 80% LTV, comparing these two numbers. We also see that if prices were zero, these high LTV borrowers would have chosen more coverage. So the main effect is strong and positive. Those results persist even when you look at an even narrower band around 5% instead of 10%. We get very similar results. So to kind of put these results together, we're seeing that more constrained households are 30 to 50% more elastic than less constrained households, looking within narrow LTV bands. And we're also seeing that more constrained borrowers want more coverage even at zero prices. So the combination of these two results, we argue, are not consistent with many other explanations of demand for insurance, like climate beliefs or risk aversion or literacy. For climate beliefs, if I don't believe in climate change, I would expect the main effect, I would be more elastic for my demand and I would have lower coverage levels. If I'm less risk averse, I would be more elastic and have lower coverage levels, etc. So the fact that these kind of two things go in the opposite direction, where I have more coverage at zero prices, but I'm also more price elastic, is really strongly consistent with the constraints interpretation. So in the last minute, I'm going to talk about the broader implications of our results. The implications for the market is that financial constraints are playing this important role in reducing household willingness to pay, and it's doing so much that it's even below the expected losses that are what insurers would need to charge in order to maintain solvency. And so what this means is that for the set of households that we identify as constrained, as prices continue to increase, the market is going to shrink in size. But there's also going to be this knock-on effect where households who are currently unconstrained are going to actually become constrained because they're going to require more and more debt to finance insurance premiums. So we consider this back of the envelope. If prices were to increase at historical rates, how many households would actually adjust debt to the point where they hit these binding LTV limits? And using our estimates, we find that actually between 17 to 31% of households would hit binding LTV limits. So we have these two effects where both the constrained and even the currently unconstrained households would be reducing coverage. Where putting that together, we're going to see that as climate risks go up, the size of the insurance market is going to decline because of these binding financial constraints. We have some other results in the paper where we look at how, as we talked about earlier with Ben Collier, like the underinsurance is really hitting the household's equity, not the lender. And we also see this effect where underinsurance is worsening household mortgage default, but really specifically for the constrained households or the lower income households. And I'll just conclude with some descriptive results from my favorite state of Florida. You know, if you look at what's happening in Florida, we see that insurance prices are going up, coverage ratios are going down, and LTVs are going up, loan to value ratios in the mortgage market. So of course, none of this is causal, but all of this is suggestive that some of the dynamics that we really try to carefully identify, we're already seeing them playing out in aggregate trends. So I'll stop there. Thank you so much, and happy to do more Q&A. And my co-authors are also on the call, so Ishita, Anna, feel free to jump in as well.